All right, good afternoon, everyone. We will go ahead and get started. First, I want to welcome you to the National Center for the Middle Market Year-End 2021 Middle Market Update. During this webinar, we will be walking through a detailed explanation of the current performance, sentiment, and trends in the current middle market sector based on a semi-annual survey of 1,000 mid-sized companies across the United States. My name is Erica Voki, and I'll be monitoring the Q&A function throughout the webinar. Feel free to drop any questions you have in the Q&A section at the bottom of your screen, and we will do our best to answer each question. Also, please note that this session is being recorded and will be uploaded to the center's website for future on-demand viewing. And now I am pleased to introduce the National Center for the Middle Market's founder and managing director, Doug Farren.
And welcome everybody to our event today. I'm so glad you could join us for this important update on the middle market, the U.S. middle market, and performance for the year 2021, as well as projections out into 2022. And we'll be looking at a couple of key issues and challenges that are facing mid-sized companies as well. So, as Erica said, my name is Doug Farren. I'm the managing director of the National Center for the Middle Market. I've been with the center since we launched in the fall of 2011. And for those who have attended one of these updates before, or if this is your first time, the message will be the same, and that we're going to be running through a lot of data. We should have some time at the end for questions. So as Erica said, please don't hesitate to put some of the questions into the Q&A box.
Doug, sorry, I'm just going to interrupt quickly. We're getting some comments about the audio being a little bit choppy right now.
Okay. Yeah.
Still a little choppy.
Was that any better?
Not yet.
Okay. Let me switch to my microphone. I want to make sure that people can hear me. So I'm going to turn off the light since my image isn't
as the slides. Is that better?
Yes, that is better.
Okay, awesome. All right, well, thanks for, at least I know everyone's paying attention because I see 8 quick hand raises and Q&A chats. So appreciate letting me know about that. I tested everything beforehand, but glad to see it's better now, hopefully. So let's get rolling with all this great information. So for today's session, I'll start very, very briefly with a little bit of background, talk about the center, the middle market itself, and the MMI report, just so everybody has a clear understanding of how we go about collecting this information. We'll spend a little bit of time talking about performance and sentiment for the year 2021. Then we'll look forward to this year, what's next in terms of projections and outlook, and finally, wrap up with some discussion on some data we were able to collect around 2 headwinds that aren't going to be a surprise to most of you, which are supply chain disruptions and workforce challenges. We'll wrap up and then have some time for some Q&A if those will happen to come in. So the National Center for the Middle Market, we are a collaboration between the Ohio State University Fisher College of Business, Chubb, and Visa. Chubb has been with us for the last several years, and I'm happy to share that Visa has joined us as a full sponsor as well. So our 3 organizations really have continued on the mission of the center, which is to make sure that middle market companies are fully recognized for their contribution to our economy. How do we go about doing this? Well, I think foundational to what we do is our research. So in addition to the semi-annual middle market indicators, we also do lots of topical research on business issues ranging from globalization to talent management, digitization, innovation, and so forth. We also have a number of partners around the country, industry trade groups, chambers of commerce, economic development organizations. All of these groups share a similar interest to ours, which is making sure that their middle market companies get the recognition they deserve and also the support that in many times they need to be able to continue their strong growth and overcome challenges that they might have. Finally, education as a business school, we take it as our mission to take a lot of this middle market data and educate both our students at the undergraduate and graduate level, as well as executives. And so that's really what we've tried to do over the last 10 years. The middle market, these are our standard definitions. Again, just so everybody understands where we're coming from. We use a revenue-based definition of 10 million to $1 billion, which of course is a huge range. Within there, we can sub-segment by different revenue categories. So our lower middle market is 10 million to 50 million in revenue. Our upper middle market is 100 million and above. So in many of our data sets, including the MMI, we have the ability to look at it in those different cuts. About 200,000 businesses, we say about because of course this segment is constantly changing. You've got companies that grow into the middle market. You've got companies that grow out of the middle market. There's lots of M&A activity. So never a stagnant number, but that's roughly the size of the middle market in the US. These important companies, of course, contribute a third of our private sector GDP and employment. And about 85% of them or so are privately held, which again makes data very difficult to come across. And so as a center, we have taken it as one of our objectives to provide this type of information, data, to a variety of audiences. So we're glad you're here to hear about it today. The middle market indicator, just want to make sure everyone is aware of the survey process that we use. So this is a national survey. It is done twice a year. We used to be on a quarterly cadence, but a few years ago, we actually switched to semi-annual, which has proven to be pretty effective for us. We also recently just underwent a very subtle naming convention change. So with the removal of 4 quarters of surveying, we now call the middle market indicator mid-year and year-end. So this is our year-end report. We survey 1,000 C-suite decision makers. So could be owners, founders, CEOs, CFOs, you name it. They just have to have a significant stake in financial decision making for their company to be able to answer a lot of our questions effectively. Of course, we look at some key insight areas, the trend data that we've collected over the years, looking at things like revenue growth, employment growth, confidence in various levels of the economy, key challenges to the company, as well as capital investment planning. And so we're going to take a look at all of that data today. This survey in particular, important to note that the survey data was collected during the first 3 weeks of December. So we went out into the field shortly after Thanksgiving. We're in the field for about 3 weeks, as I mentioned, and then our report was officially released on January 26th. So if you haven't had a chance to look at that yet, I would encourage you after this to go look at the full report and data. So let's dive right into what's new with the middle market. So first, for about the last 4 surveys, so going back to March 2020, we had specifically been asking questions about the pandemic. We made the decision this time to largely eliminate those questions, although we kept a few in just to understand kind of general state of play. But at this point in time, almost 2 years into this environmental situation, we felt like it was time to really just focus on other things. That being said, I wanted to lead with this first slide, which is more of a qualitative assessment that we asked the respondents to tell us the state of their company's performance as of the end of the year, specifically as it relates to before the pandemic. And what you can see here is that 2/3 of the companies are saying that they're doing better than they were at the end of 2019, which is obviously great news. In the summer, during our mid-year update, we talked about a recovery. We saw that in the data. Growth had returned in both revenue and employment. We saw investment spending start to slowly creep back, although lagging. The issue that existed, though, in the summer was that it was a very much of a split recovery, in that you had a set of companies doing very well. You also had about a third of the companies that were still struggling. So revenue and growth had either been flat or continuing to decline. What we're seeing now is what we're going to call a much more universal positive recovery. 2/3, as I said, of the companies saying they're doing better than before. And as you'll see in the upcoming data, that's been backed by the results. We're also continuing to see record high growth rates and optimism that is consistently high across the three dimensions of global, national, and local. Although that capital investment continues to lag somewhat, we feel like it's on its way to recovery as well, and you'll see that. So this is the primary dashboard. Again, if you've been in one of these presentations, you're very familiar with this layout. Starting on the left, let's focus on revenue growth. So for 2021, average revenue growth across the middle market, 12.3%. That is an all-time high. Small disclaimer, you have to also take into consideration that we're comparing against the prior 12 months, which, a year ago, our growth rates were in fact negative. There was a decline in both revenue and employment. So you have to take this with somewhat of a grain of salt, that we're comparing over a very difficult year for the middle market, but still very, very great news to see these rates as high as they are. Going down further on the left, for revenue growth projected at nearly 10% in 2022. We also typically compare to the S&P 500, the revenue growth rates there, and that's at 8.4%. So as we normally see in this data, the middle market continues to outpace the S&P in terms of top line growth. Moving over to employment growth, 10.8%. Again, very, very strong. And these are the highest numbers we've seen throughout the 35 MMIs that we've completed. And that growth is projected to remain strong throughout this year at 10.3%. Similar to what we do with revenue, we also use ADP reporting as a proxy for small and large businesses. So their data is very much based on headcount, but we feel like, again, it's a great proxy to compare growth in other size segments of the US business environment. You can see small business grew at about 5%, large businesses somewhat below that at 4.4%. So again, the middle market is, doubling at a minimum its peers across both small and large. Capital investment. So this is the question we ask in the survey is actually, if you had an additional $1 of revenue, what would you do with that dollar? The options are to say we would save it, put it in the bank for a rainy day, use it toward a financial investment, or we would invest it back into the business. And then here's where we would put that. So 6 out of 10 companies saying that they would be willing to invest, which is getting better. It's improving since the depths of the summer of 2020. But as we'll see here in a few minutes, it hasn't quite returned to normal historical levels. And then finally, we look at confidence. So the 3 levels that we measure are global economic confidence, national economic confidence, and local, which would be, your immediate town, city, region, as we know that there's a majority of middle market companies that are regionally focused. And these numbers are slightly off from what we saw in the summer, but still right in line with what we've traditionally seen. And again, the pattern with local economic confidence being highest and global being lowest is also very consistent with what we've seen over the course of time. Okay, let's click down one level here and look at year-end revenue growth. So again, I mentioned the reported average 12.3% versus that 8.4% for the S&P 500. This trend line is very helpful to view kind of how things were very consistent, kind of pre-pandemic, the big drop off we had in 2020, and then this strong recovery that we've seen over the last two surveys. So the average in this time period that you're seeing here is about 7% top line revenue growth. And you can see that that was pretty much the case throughout 2017, 18, and 19. Also very consistent that the middle market was outpacing the S&P. So these are not, there's nothing here that's surprising to us, very, very consistent. And then of course, March 2020 comes along, that first summer with the severe fallout and uncertainty is where we see the enormous dips and declines actually in top line growth, with a rebound to 8% growth in the summer of this year in our mid-year update. And then, as I said, finally year-end 12.3. That last number you see out to the right, again, is that projected growth of 10%. We have a section in our MMI report that kind of talks about those projections. And historically, what we have seen is that the projection typically is very conservative, and results tend to beat that projection over the course of time. Of course, 2020 and the early part of 2021 excluded, when there was so much uncertainty that caused projections to be all over the place. But overall, a very, very good growth story in terms of revenues in the middle market. Now, I want to spend a little bit of time looking at this chart because I think it's very interesting as you peel back the elements that make up that overall growth rate. So if at the far right, you can see for this year-end survey, 78% of the companies reported revenue increases. Most importantly, though, that large green area, the 56% of companies are growing at 10% or more since the end of 2020. So that is, again, what is spurring our commentary around more of a universal and robust recovery versus the summer, which you can see immediately to the left. 66% of the companies were reporting revenue increase. And while they were still a pretty healthy, almost 60% of the companies reporting 5% or more growth, the problem was at the other end of the spectrum, you had 34% saying that they were still either flat or declining. So again, the overall story in our mid-year update was an 8% average, which was great, exceeded the historical trend, but it wasn't as robust as we would have liked to have seen. And now we're getting closer and closer to that. Of course, going back to pre-pandemic, you can see the growth leaders, those 10% or more, 20 percentage points higher than we saw at the end of 2019. And those struggling, either flat or declining revenues, 5% lower. So again, this kind of paints more of a full picture of how these companies are performing. And I didn't mention it at the beginning, but it is important to note that all of the data we collect gets weighted to the US Census. So in other words, for industry, size, and geography, we map that to the makeup of the middle market by the US Business Census, which means that these reported averages aren't skewed by any particular oversampling in a specific industry or a specific size group. Looking a step deeper as we look at the different industries, not much to say here about anyone struggling in particular. In fact, all industries performing quite well. The left-hand side of these charts represent the past 12 months. The right-hand side represents the projection for 2022. I've circled the three strongest growth rates, those being financial services at close to 19%, which is really quite amazing. Services would be business services. Think accounting firms, law firms, any kind of B2B type activity in the business space get classified into that category. And then finally, retail trade for a industry that's taken such a beating over the last almost 2 years. Very nice to see middle market retail companies have really skyrocketed in terms of their revenue growth rates. And again, these would include your traditional retail outlets, restaurants, e-commerce, and so forth. So looking ahead to next year, very similarly, financial services, business services, and retail also are projecting some of the strongest growth rates we see by sector. Another area that we ask about is in terms of expansionary activity. And I was really surprised to see these results because we really measure 4 different areas of expansionary activity. Those would be taking on new debt. So, trying to fund growth activities across the company, adding a new plant or facility. So thinking about physical expansion of assets, expanding into new domestic markets. So, I talked a little bit earlier about, in a general sense, the regional focus of a lot of mid-sized companies. So as they think about how to grow, thinking about different markets that they can sell their products or services into. And then finally, which is actually the highest percentage of companies this time around, introducing a new product or service. Going back to 2018, we haven't seen this high of a percentage of companies saying that they are going about introducing new products or services in a couple of years. And I think that speaks to, a lot of the pivoting that's taken place over the last almost 2 years, thinking about, complementary products, shifts in either production or service activities that allows middle market companies to be quite agile and responsive to the needs of their customers. When you think about all the remote work, all the things that have been happening to kind of create seismic innovation and needs throughout the customer base of a lot of these companies, it's pretty encouraging to see that a lot of the companies are responding in a way that introduces new product and service offerings. So something we'll definitely keep an eye on and want to understand a little bit more, but have heard this anecdotally in some CEO forums and some other discussions that we've been having over the last 4 or 5 months. Let's shift over to employment. So kind of a similar chart here, the 10.8% employment growth, really positive, especially considering the increasing tightening of the labor market. Small and large, again, much lower in terms of their growth rates based on the ADP data that we've collected. And then once again, this chart does a great job of showing where this trend has been over time. The collapse, again, no need to go into it any further, but you can see the big dips and then the recovery where the middle market is kind of, strongly outpaced both large and small in terms of its recovery, where it's been averaging about 5% revenue growth. And it's, obviously double that for the year end with a strong projection for 2022. And as I mentioned in previous presentations, the real key is going to be whether that type of employment growth is actually going to be achievable, given some of the headwinds that we'll talk about here a little bit later in the presentation. Again, kind of a similar chart when you go down on another level to look at where the employment increases are actually happening. So again, at the far right, you can see for the year, 57%, almost 6 in 10 companies saying that they've increased their headcounts for the year. And 43% of the total sample have increased 10% or more. So, you obviously have to take into consideration maybe some of those companies that had to let some people go early on in the pandemic. They've had to go back out and, replace those workers, bring people back to help support the growth that we're seeing. In other cases, you're continuing to see both inorganic and organic growth. So lots of different variables in play here. I think what's also interesting is you look at the bottom in terms of companies that haven't changed their headcount or are decreasing their headcount. That's at 43%. And again, when you go to the far left and compare it to pre-pandemic, that's almost 10 percentage points lower than what we were seeing at the end of 2019. So this employment story, again, is stabilizing, but lots and lots of challenges out there as companies thinking about, one, being able to find the right people, attract them, develop them, and then ultimately retain them in their businesses. Similar chart here by industry. Once again, I've highlighted the top 3 growth industries by employment growth rates. Financial services, once again, leading the way at about 19% overall employment growth. Wholesale trade is next, although I will caution our sample size for wholesale trade is traditionally very small. So I would not put a whole lot of stock into that number, just because while it's statistically significant enough, it's really not at a level of any of the other industries. So just a note of caution there. And then retail trade, again, has grown in the past year at about 13.5%. Looking forward to this year, we see strong growth rates across the board projected, but again, in financial services, business services, as well as retail, being areas that are really looking to add employees. Our economic confidence trends, last survey, so in our mid-year MMI during the summer, which was collected in June, think about what was going on at that time. We had vaccine rollouts. We had, much lower case counts and issues around the pandemic. I think generally there was a lot of confidence that we were seeing the light at the end of the tunnel. We were going to come out of it. Delta had not hit, let alone Omicron, but I think there was this overwhelming enthusiasm about finally being able to get back to some sense of normalcy. So that's when we saw actually all-time record highs. Where we're at now, we're not necessarily too far off the trend pre-pandemic with the 75% global confidence. You can see very much in line with 2017, 2018 numbers. Nationally, 81% feeling very confident. Again, not far off the pace that we were seeing, 17, 18, 19. And then locally, we're right where we were as well. So a little bit of a drop off again, but the summer I think may have been overly inflated with this sense of finally seeing some normalcy, having some tools at our disposal to actually get back to business as close to usual as we're ever going to see. This is that investment chart. So pretty interesting shape here when you look at this diagram. The green line represents the companies that are saying they would invest their additional dollar. The blue line are those companies that would say they would save it. And, historically, we've run around 65-70% on the invest, particularly as we've been in this long-term environment now with very low interest rates, perfect environment to be able to take on debt, although we know not many middle market companies like to do that necessarily. But if they have to, it was a great environment to do that. Given uncertainty and just not knowing what was going to happen in the future, we really saw this, the brakes kind of applied in the summer of 2020. And then again, despite the strong performance, despite the glowing confidence, it's still been a matter of kind of lagging to get back to the levels that we saw previously. We're at 60%. Saying that they would invest, which you can see is not quite up to what we saw in the years preceding the start of the pandemic. So again, our expectation is that as long as that growth is there, as long as there are employees able to drive growth, then that we're going to continue to see investments back into the business. So the next logical question is, where are they investing? And we do ask for these respondents to identify where they would invest the dollar. On the left-hand side, you can see from our summer mid-year update, the primary allocation would have been toward plant and equipment. About a quarter of the companies saying that they would invest in physical assets. 18% saying information technology. Not a big surprise given all the work from home, hybrid, remote, the need to basically access data from anywhere, cybersecurity, those types of things. And then 18% personnel, training, and development. Now, at the end of the year, we can clearly see that IT has taken the driver's seat in terms of capital investment planning, followed closely at 22% of the companies saying that they would invest in more people, personnel, headcount. So, there's always jockeying that happens in these charts. It's interesting to see how things change over time, but very, very clearly, this tells us that, the thinking of middle market leadership is beefing up our technology, could be as a result of either, planned or unplanned digital transformation taking place within the business, or, making sure that we've got the right workforce to support growth. So these are themes that are going to continue to pop up, and not only in the middle market. I mean, I think we see this in across businesses of all sizes, but particularly for our interests here at the NCMM, this is what we're going to be continuing to watch. So now what? As we think about 2022 and some of the opportunities and challenges that exist out there for the middle market, this is just a quick chart on projected revenue growth. So as I said, we asked these leaders to think about the year ahead and what they would estimate in terms of their revenue growth. Very strong, almost 10%, which is on track with the results that we're seeing here for the end of 2021, and very much in line with what we were hearing in the summer. So that has not been impacted by some of these other issues, the ongoing strain of dealing with pandemic-related challenges, the strain of, potentially workforce issues, inflation, external issues that, some things definitely outside of the control of the management team. So very, very curious to see how this lands. And like I said earlier, a lot of times these are very conservative projections, and we have seen a strong relationship between actual performance, typically beating the projection. So we'll see what happens a year from now. Similarly, on the employment growth side, chugging away at about 4% over this time period. I think I maybe chopped off 2017 for this view, but it's rebounded nicely, and there's a strong forecast at 10.3%. So good news there on the employment growth side, and we're going to be monitoring this very closely. Well, let's shift gears a little bit and talk about challenges. So we ask our survey respondents to think about their challenges in two ways. So over the next 12 months, i.e. 2022, what are things internally that are going to be challenging to the business? What are going to be things that are externally challenging to the business? You can see number one in both cases are core business issues. That is a general term that we use to roll up lots of different areas of the operation. So supply chain, costs, vendor relationships, revenue growth strategies, growth in general, a lot of just kind of what I would call signature management related topics that almost every business thinks about and deals with constantly. Interestingly, though, you can see that almost 50% of the companies say that talent management is going to be one of their most significant challenges this year. And then there's a big drop off, excuse me, especially internally around managing COVID-19. I think we're kind of okay. We've been there, done that. We're going to move on. And then the cost element, which has been around for a while now. And then externally, companies continue to think about the pandemic, talent, as well as the economy as a whole. So I boxed those business issues and talent management because one of those lingering questions, I'll call it, that we left in around COVID was around the impact to business functions in the coming year. You can see some of the historical shifts here. So the bars and the categories to the left are organized by our most recent survey, but you can see how things have kind of changed and shifted over time. But right now, the two areas with the largest impacts would be supply chain at 36% of the companies saying it's either a severe or minor impact, and then employment being the second. And we're going to go into these in even more detail because we asked a whole series of follow-ups on exactly what that means. So the first topic we'll visit is supply chain disruption. Of course, if you read any business journal, if you watch the news, you heard about supply chain disruption. Probably everybody saw the 100 containers sitting outside the port of Long Beach. Prior to being at the center, I myself am a recovering supply chain and logistics professional. So while on one hand, it was very encouraging to see so much attention being paid to my former profession, it was also, usually in a negative light because of all the issues that were going on. So we wanted to take a look at this, just like all the issues we've explored in the past, and see how supply chain was affecting the middle market. This first chart is data we've been collecting for a while, not specific to this survey or specific to supply chain, but it's around risks. And it's kind of interesting to see how businesses consider their various risks. So you see them all there in the legend across the top. You've got cybersecurity, change of leadership, catastrophic incidents like natural disasters, competitive risk is always one that's out there. Well, in the last year or so, we've added the pandemic as well as supply chain, which has been in there for a while. But you can see that the pandemic related risk is still pretty high at 60%. And then supply chain is that second one there in the circle at almost 50% of the companies saying it's a significant risk for their organization. In terms of the impact, so from our respondents, almost 50% of the companies had said they have been impacted by some form of supply chain disruption or constraint in the past 6 months. More specifically, it probably comes as no surprise then that the two industries most acutely impacted by this have been manufacturing and construction, which of course rely on the most amount of raw materials and goods that flow through their supply chains, where of course a business services company or a tech company may be entirely immune from this issue. So those are the companies that are definitely telling us that there's been an issue. How bad of an issue? Well, of those impacted, 83% said that there was a negative impact on their 2021 revenue. You can see kind of the different scale here. Most of them said it was between 1 to 10% or so. About 78% of that total impact was in what I would say not insignificant range, but probably not devastating to the company. What's most concerning though is you look to the revenue projections for 2022, and almost all of the companies are saying it's still going to linger on and affect them for this coming year. Again, about 70% of it in that 1 to 10% negative impact on revenue range. So the story here is, yes, this is a problem. It is definitely being felt by middle market companies. As I said, in manufacturing and construction, if you're in that industry, you can probably speak directly to this, that, you may have seen not only lack of availability of materials, but certainly cost increases in shipping costs, these types of things, which definitely have an impact on the bottom line. What aspects are most challenging? So again, not a whole lot of things that are surprising here. 60% of the companies saying the disruptions themselves have been challenging. Most supply chain people will tell you that most of their lives are spent planning out the next 6, 12, 18 months. But maybe some of this came in surprisingly and caught some people off guard in terms of just the extent of the delays and the backups and the lack of getting those necessary raw goods and materials within their supply chains. Growing complexity. We did some work a few years ago where we looked at middle market supply chains, and one of the big takeaways from that study was that a lot of middle market companies tended to rely on maybe 1 or 2 key partners to provide them with their key goods. As supply chains continue to grow and expand, that comes with it its own set of complexity issues around management, around exchange of information and data, around having visibility into the supply chain and knowing where you stand inventory wise at any moment in time. Relatedly, the size and scale is another demonstration of that. as well as globalization. So as more of this flow of goods has been coming in internationally, that has been impacted by the disruptions we've seen, at various times across different ports and so on and so forth. So what are they doing? How are they kind of mitigating or approaching this? So, some of the tools that are being used here, you can see on the left, relying on a 3PL, been around for years, not an uncommon approach. Using somebody who specializes in this type of work, has the types of relationships and infrastructure in place to move your goods and materials most effectively. You can see data exchange, link systems. 23% have no tools in place to identify their supply chain risk, which is, that's pretty concerning, especially in light of what we've seen in the last 6 months. And then approaches. So how are they mitigating? And, these didn't surprise me as much as well. So finding alternate sources of supply. If you do have that key relationship with your one main supplier, well, guess what? Maybe it's time to diversify, just like a good stock portfolio, and have, maybe 2 or 3 backups in play, or shifting some of that mix from 80-20 to more of a 60-20-20, so that you've got, you're insulating yourself from some of that risk should your supplier shut down, or should, there be issues with logistics and movement of goods. Finding suppliers in multiple regions. Again, as we see upticks in COVID cases, factories and warehouses shutting down, the more geographically diverse you can be, the more you've addressed some of that risk. And then the last one is probably, goes against all the principles that you're taught as a good supply chain person, which is basically increasing your inventory. So increasing safety stock, having more materials on hand, so that if you are hit with some type of a disruption, that you can continue on with your own production and business line without being excessively caught with the lack of the materials that you need. So again, hearing this qualitatively as well as what we're seeing in the data as the approaches. The last thing I'm going to talk about today is workforce. Has not been a new issue. Even going back to 2015, we first saw talent kind of emerge as a key challenge for the middle market. As the labor market's been really tight for a number of years now, there's just a lot of competition out there. And of course, some of the socioeconomic issues we've seen have impacted workforce participation as well. And middle market companies are not immune from feeling this. In terms of size of the workforce, majority say it's just about right now, but 30%, 3 out of 10 are saying, for our market conditions, for the type of demand and growth that we have and the plans that we have, we do not have sufficient workers to help support that. So, this is going to be a pretty complex issue that companies are thinking about ways to deal with. As we think about industries, again, in terms of the top line there, which is insufficient, construction and healthcare, particularly healthcare, right? We're seeing about the number of people getting out of that industry, whether they're burned out, they just, the last 2 years have been just too much to bear. But a lot of people exiting, and a lot of need in the healthcare, construction, even to some extent, manufacturing and services, not having sufficient workforces. Some of the universal challenges right now are around the skills. So over half the companies are saying that they're extremely challenged right now around finding workers that have the right skills for the type of work that they have. 96% are feeling this to some degree, 51%, as I was saying earlier, extremely challenged. Some of the issues around hiring. So what's happening as a result of not being able to find the right people? Well, unfortunately, the burden's falling on the current workforce. 54% of our respondents say that their employees are having to work longer hours, take on more shifts. And And that's not ideal in the long run, right? Because the longer you do that, you're going to start churning and burning people out. And so definitely something to keep an eye on. Also extremely concerning is, a third of the companies saying that they have to slow down their productivity or their sales because of the inability to hire people. So that is pretty hard to believe, actually, that people are putting a governor on their own sales growth. But I'm sure you may have heard stories out there about companies having to do this, where they're limiting orders, or they're not being as aggressive with new customer development just because of this issue. So definitely not ideal. Don't want to see that ever happening. We'd love to see these companies continuing to grow at strong rates. You can see some of the other reactions, outsourcing, maybe temp labor, bringing in consultants, cutting product lines. I mean, none of it's good, right? But necessary, unfortunately, in this type of environment. Digital skills. We've been talking as a center now for a couple of years around digital transformation and the skills gap. You can see here, 40% of the companies think they have a digital skills gap right now. 66% of those respondents think that it's having a substantial impact on the performance of the company, as well as its ability to grow. So we've got work out there. Again, we've done some previous white papers, some articles around the digital transformation process for the middle market. We believe it's not as easy as just one or two areas. There's actually about 6 areas to consider. Doesn't mean that they're all necessary priorities, but how you produce it, how you sell it, your IT infrastructure, your workforce, your enterprise thinking, all of those are very important. And in this case, obviously having the people with the right skills is extremely important. And then again, just kind of building on that, 96% of companies saying having digitally savvy talent is going to be important to their success. And some of the obstacles that they're facing in finding these people is just having the base in their geography. This might be starting to ease a little bit as we're seeing more and more hiring with remote work, the ability to hire people from wherever and have them work for your company. But again, having people in your geography, competition out there, not only from mid-market competitors, but also large and small businesses, and then having the financial resources to support the training and skill development are at this point some of the biggest obstacles that these companies are facing. So in summary, really good news overall, right? So that's the first thing. 2021 has proven to be a bounce back year for the middle market. But as I mentioned and kind of showed everyone earlier, a more universal recovery. Confidence very high, kind of dropped off a little bit from our historic highs, but still very strong. And then the projections that we're seeing for next year are going to be impacted by these external factors like inflation. Rising interest rates are going to make things a little bit more challenging, but some of the internal issues for companies to think about around supply chain and talent will also be top of mind. And I just covered these two. So half of the middle market facing disruption, impacting both last year's as well as this year's revenues. And then talent has never been a bigger issue than it is right now, given the great resignation, the she session, which I read about here in the last month, and also the lack of digital skills kind of contributing to all those issues. So that is our story. I hope this has been informative. I invite you to visit our website, middlemarketcenter.org. We have all of the middle market information out there, including the full report, a perspectives piece. This session is being recorded. Eventually, we'll have the webinar video out there for on-demand playback as well. So if you have colleagues, people at your firm that weren't able to attend or you think would benefit from watching this, I invite you to do that. And I think we've got a few minutes for some questions. And we've got a few that have come in. So first question, how do you account for the impact of rising inflation to revenue growth for middle market companies, i.e. higher revenue does not yield higher profitability. Absolutely true. We did not have the chance to include inflation-related questions in this survey. 100% agree, though, about the difference with the top line and bottom line. Obviously, inflation, rising raw materials costs, rising labor costs, all of those have an impact on profitability. So extremely important for middle market companies to manage as best they can. For the purposes of our MMI, though, we've continued to historically track top line revenue growth, but of course recognize that these external and internal issues definitely have an impact on the performance of the companies as well. Next question. Do you have any information linking the contribution of middle market companies to the US GDP? References that you can provide that allows me to view the contribution by middle market companies to GDP for the last few years? That is a great question. In my intro there, I talked about the middle market being the middle third of GDP. So, roughly a third of private sector GDP. That has not been refreshed in a while. We have tried to work with the US Business Census to get some of the latest data, have had some challenges there, but it's definitely a very valid question and something that I would like to pursue to see if we can refresh not only the demographic picture of the middle market, but also its contribution in terms of total jobs and in terms of total GDP. I believe the census would be the correct source for us to access that. And to my knowledge, there's not any other resource available at this time that would do a great job kind of tracking that. But I'm going to take that as a takeaway. It's not something that we have ignored. It's been on our radar for a number of years. We just need to continue pursuing that information. Our last question, what is the impact of ransomware attacks on specific sectors of middle market companies? I'm surprised your data did not show this as a risk. Well, so another great question. That would have been rolled up into the general cybersecurity bucket. So we did have that on our risk chart, not specifically ransomware called out. But this is also an area that we've looked at in the past. Several years ago, we worked with Cisco. They were formerly one of our sponsors, and their primary interest was all around cybersecurity and making sure that middle market companies, maintain the type of protection that they needed. We did some work with them, some research, and a majority of middle market companies, quite honestly, felt like they weren't targets for these types of attacks. But sadly, most of them discovered anywhere from 6 to 9 to 12 months down the road that they in fact had been attacked. This is probably an issue that has only increased over the last 2 years, given the remote nature of work and more accessibility to those types of attacks on data. So that makes it extremely important, even more important, to work with the right advisors and partners to make sure that the right security is in place, depending on your business needs. I think I got time for a couple more that have just come in. Of the 200,000 companies, what is the breakdown? So a couple different breakdowns. So if you think about revenue, at the lower end of the middle market, that 10 to 50 million is about 80% of the companies. So bulk of the middle market actually lies in that lower segment. Then 50 million to 100 million, you've got close to 11% of the total companies. And then above 100 million, you've got about 9% of the companies. As you think about ownership types, I think this may specifically be pointing toward the ownership or the makeup of the organization. As I mentioned, 85 to close to 90% or so are privately held. Of that, you've got about 40% that are family-owned businesses, another 40 or so % that have some level of private equity investment in them. Only a very, very small percentage, I believe it's less than 3%, are publicly traded companies. So, actively listed on some exchange. So that is the makeup of the middle market as we know it. Is there more information on new product or service priorities, invest versus save? Is there a difference per company size? Yeah, there is actually. We do have that data. I'd be happy to follow up individually on that question to share some of that information. The products and services, we do not have a follow-up in terms of the specific nature of what those offerings might be. We just ask it as more of a general category. So unfortunately, cannot get to that. And I've got time for one more. I see one more that's come in. Have you collected data on the different challenges with talent, more specifically than recruiting, retaining, and skill? In this MMI tool, no. We generally keep it at that level just because we have so many things that we want to explore given the size of the sample. However, over the course of time, we've done several deeper dives, some research projects on various aspects of talent management. We've looked at the talent planning process. We've looked at things like employee value proposition and employer brand. We've looked at how middle market, some of the tools that middle market companies use in terms of attraction, development, retention, those types of things. So I would point anyone who's interested in learning more to some of our library in the Knowledge Center on our website. You can see a whole array of talent-related projects that we've done in the past and have presented those at a lot of different forums. So good question, though. So one more. Let's do one more since we're almost at the top of the hour. Do you have information on middle market lending? How do companies finance themselves, and what are the main difficulties faced? Again, this is not something that we regularly explore via the MMI. However, we've done a couple of projects in the past as well where we've looked at one, access to capital. I can tell you that from the data that we collected, and this is probably going back maybe 5 or 6 years, so likely due to be refreshed. Number one, a majority of middle market companies, if they do take on debt or they need financing, most of them continue to go the traditional bank route. An overwhelming majority, said that they would work with their local, regional, national bank on a traditional loan, opening a line of credit, kind of traditional debt financing, followed by the private equity markets were kind of the two biggest areas. Difficulties that they face. I mean, I think it's just understanding the process, who the right advisors to work with, having really good financial information and records. That has sometimes come to be a struggle, whether it's finding financing or approaching M&A. That's another area we've looked at where the preparation process is a lot more involved than most, owners, founders, leadership teams as they're thinking about, if they're approaching a major transition or an exit, that they have all their financial information. It's been checked, it's verified, everything, all the ducks are in a row, so to speak, because that in some cases has been a significant challenge for these companies. So, well, again, I appreciate all the questions and the interest. We are out of time. If there are any that come in here, I think one or two have just come in. We will respond to those directly. And like I said, we're looking forward to our next middle market indicator, which will be fielded in June with the results to be released in July. And then we'll schedule our mid-year update for August of 2020. So thanks again. Hope you all have a great day and appreciate your support of the National Center for the Middle Market. Thank you.